Welcome everyone for joining us today. We got a big group, so I'm going to let everyone file in. And we have a lot to cover today. It's our annual State of the Legal Industry review. My name is Phil Flora. For those that don't know, I'm a Vice President of Sales and Marketing here at Leopard Solutions. Joining me from Leopard Solutions is Laura Leopard, CEO and founder of Leopard Solutions. The structure of today's webinar, the first half hour or so, give or take, or at least the first half of it, is going to be Laura presenting the research from 2022. And then the second portion of it, or second half of the webinar, will be a little Q&A session, or at least a little analysis. We have the privilege of having three wonderful panelists with us today, and I appreciate them taking some time to provide their thoughts on the research in 2022 and as we look forward in 2023. So today's webinar is being recorded. I'm going to be monitoring the Q&A chat, so if anyone has any questions, you could drop it in there, and we'll take it from there. I'm going to before I turn it over to Laura, I'd like each of the individual panelists just to do a quick intro of themselves, and I'm going to share their LinkedIn so you guys can connect with them directly if you'd like. Toby, why don't we start with you, if you don't mind?
And I'll keep it as brief as possible. I'm Toby Brown. I'm the CEO of DV8 Legal Strategies. The premise of DV8 is that, as far as I can tell, every law firm has the same strategy. And so what I'm trying to do is help law firms deviate from all having the same strategy so that they might succeed. So various strategic counseling to firms, clients, and other providers on what's going on in the market and how they can best take advantage of it. Previously, I was the Chief Practice Management Officer at Perkins Coie, oversaw a number of things like pricing, legal project management, client relationship group, practice management, and things like that. But also relevant to this, I oversaw our lateral partner acquisition program. So that's a brief background on me.
Awesome. Thanks, Toby. Appreciate you joining. Carmen, you mind just a little brief overview of yourself?
Great. Thanks, Phil. I'm looking forward to the discussion today with the panelists. At Morrison & Foerster, I work directly with our firm chair and executive leadership team on the firm's strategic growth initiatives. My role encompasses oversight of lateral recruitment and integration plans for the US, Asia, and Europe. During my 18 years with the firm, I've designed and led a variety of lateral partner and non-partner attorney growth strategies. I currently work with an amazing team that is truly talented and helps me get everything done that needs to be done, including points of differentiation in our recruitment and integration that we do for the firm. Prior to joining Morrison & Foerster, I was in the banking and finance industry for about 10 years.
Awesome. Thank you, Carmen. And Kent?
Hi, everybody. Kent Zimmerman, Zoe Kaiser Group. Thanks a lot to Laura and to you, Phil, and my fellow panelists for the opportunity to do this. I'm glad to be on here. My partners and I advise law firms on strategic planning, typically at the firm-wide level, sometimes at the practice, industry sector team, office level. We also advise on growth, and the largest focus of our work on growth is on combinations between law firms. That's a very busy part of our practice. We don't do any lateral recruiting, though. It's mergers that we focus on. We've worked with about 80% of the AmLaw 100 over the years, and before consulting, I was a general counsel. Thanks again for having me.
Awesome. Thanks for joining. All right. So with that, Laura, you can take it away. I know you have a lot of good insights to share, so take it away.
All right. Thanks, everybody. We're so happy that you're all here with us. And now I'm going to start sharing my screen. So we really took a deep dive this year. We looked at data from multiple angles. So I'm just going to jump in and see if we can get started. I'm going to move some things out of my way here. Okay. So by many distinct measurements, the legal industry is showing some signs of recalibration, right? The softening demand for legal services like M&A and capital markets came as a surprise to firms who staffed to the max over the last 2 years in those areas. And corrections for that confidence are ending at times with layoffs or in attrition gaps. Many COVID-era rules are proving very hard to roll back, and firms are having a hard time getting attorneys back to the office. Some firms are finding it difficult to get associates to work extra hours. Many worry about the future partnership track. Firms have fiscal concerns around associate pay and waning business. Associates ponder if partnership is really a viable track. 2023 will be a time to recalibrate needs, staff, and the outlook for the legal industry. If you don't know our Leopard Law Firm Index, you should. We created a score-based system to look at firms in real time to judge their health and stability. We use hard data, not self-reported survey material for this ranking system. In 2021, we saw that 41% in our top 250 list had decreased in points. 32% had dropped an entire status. 4% dropped a couple of statuses. So let's look at 2022. What a difference a year makes. Scores for firms just across the board improved, and this chart has a very different look from last year. 50% of the firms in the Leopard top 250 increased in points. Only 9% saw a decrease. Only 3% dropped in status, while 38% moved up in status. You can find our top 250 on our public pages, so it's free. Just go to that resource tab and go there. You can see the scores of all the top 250 firms in the country. We currently watch over 5,000 firms, so these firms are at the very top of our list. These are the top 20 firms of 2022, according to our ranking system. They have consistently reached the top level of our ranking system by achieving excellence in attorney growth and stability, and we congratulate them all. We also have a very special badge that you can put on your social media or your recruiting pages. Now, you're going to hear a good deal about diversity in the presentation today, so it's good to know, how and where it comes from. So this is not survey data. This comes from available data points found on publicly available sources. Every attorney in the system receives a diversity score, and that score points to them either having a high probability or a low probability of being diverse. So let's just jump right in. So here we are looking at who makes up the top 200 firms by diversity measurements. I've got 3 different categories here. The top is both gender and ethnically diverse attorneys, where almost all categories went up by 1%. Looking at those who are just gender diverse in that middle graph, you see complete parity on the associate level. It is 50-50. And then there was a slight gain of 1% on the partner and counsel level. For those who are ethnically diverse, they went up 2% on the associate level and 1% on the partner counsel level. So it was good to see all those numbers going up. The partnership level, though, is really the most important spot for both to gain in points and numbers. Both went up by 1 percentage point in 2022. And that's kind of a big deal because there were years it did not go up by a full point, but it did this last year. Promotions to partner still lag for women, even though they've made more progress than other underrepresented groups. There is still a number of roadblocks for women that just don't exist for their male counterparts. They cite lack of opportunity, unconscious bias, a lack of acknowledgement for their successes, just a few that we can name. We also see that women are dropping out mid-career in greater numbers than men. Women are being encouraged early in their career, and firms are hiring more women than men from law school. women also outnumber them on campus, let's remember. But women say that support is lacking for them at the mid-career level. Who you choose to hire shows the world who you are. We will take a look at hiring patterns from 2022 and beyond. We took a bit of a deeper dive this year to see the larger hiring patterns and how that might affect these firms moving forward. So here we're looking at all types of recruitment, both lateral and entry-level hires. We're really sort of concentrating on, the top 200 firms in domestic recruiting. And the entry levels saw a really huge drop in Q1 of last year, while lateral hiring sort of continued normally in that quarter. They sort of were underwater in all quarters for those entry-level hires, except Q3, where there was a positive of 32%, but then it went right back underwater in Q4. As a matter of fact, Q4, everybody was underwater. These schools achieved triple-digit hiring numbers in the top 200 in 2022. Georgetown led with the hiring of 304 entry-level associates. Harvard was second with 301. Now, these students were hired in 2022, but some have already left their firms. The largest quarter, if you remember, for those entry-level associates was Q3 in 2022. So many might have had sort of a short tenure. The total number of entry-level hires in 2022 was 6,364. Now compare that to the 9,507 that was hired in 2021. So it was down 33%. It was really sort of a disappointing year for entry-level hiring. Now here are the lateral numbers for our top 200 firm grouping. And what we do, the firms that are in the top 200 right now, we're looking at their history year over year over year. If we had kept on a normal pace instead of that big falling off the cliff there in 2020, the numbers would be very close to where they are today. So if we just follow that pattern, 2020 should have been about 11,560 lateral hires. 2021 should have been around 12,160. And 2022 is just about 90 hires off from this projection. So we're really not that far off the mark for lateral hires. So this year, this is something we didn't ask last year. We wanted to know where these laterals came from, as we had heard from mid-sized firms that they were really taking a beating in 2021. So we were curious to see where they came from this year. So we saw that 23% of laterals coming from firms under the top 200 in our database. That was 23%. 9% were from firms that had under 50 attorneys. So maybe these were specialized boutiques that they were pulling from. 5% were from firms that had 51 to 100 attorneys, and 6% came from firms that had between 101 and 200 attorneys. 13% came from law firms that are not included in our database. So if you add all of those groups together, that means about 36% came from smaller firms outside of the top 200. So they weren't just swapping back and forth. They really mined some of those smaller firms. 7% came from in-house companies and 5% from government agencies. And we just took a very quick look at this same chart for 2021, and it looked about 33% that year were coming from firms, outside the top 200. So it actually grew this year. So if they had complaints in 2021, they probably also had complaints in 2022 about the top 200 taking their folks. So let's look at diversity hiring. So this is ethnically diverse associates over the last few years, and just sort of concentrate on the gaps. So we have lateral hires in the blue and the orange. We have entry-level hires in the gray and yellow. So let's look at the laterals first. 41% gap in 2019. It went down to 40 in 2020. Then we had a 33% gap in 21, which is great. That's the lowest drop, right? But in 2022, the gap increased again, and it was about 35%. On the other hand, for entry-level hires, it's really pretty much the same. It was 43, 42, 41, back to 42. If the top 200 are really serious about adding more ethnically diverse associates to their ranks, it's really on that entry level where they can begin to make a lot of number differences. But we're really not seeing that increase. So now we're going to look at exits. So just a quick note about them. All of these attorneys exited a top 200 firm. So everybody we're looking in this chart exited a top 200 firm. We really easily know if they return to another top 200 firm, or if they return to a firm that we cover. We cover over 5,000 firms. So if they land at one of those, we got them. Or if they go into one of our in-house companies, we have over 7,500 of those, right? So that's a sure thing. In the unknown column, that's there because we're unclear at this time where they went. And we will continue to research this week after week to try to locate, where they landed. Over time, that unknown column shrinks as the other columns grow. Well, here, we see ethnically diverse women, which is what we're looking at here. They exited the top 200. They returned in far fewer numbers in 2022. So in 2021, they re-entered a top 200 firm at 40%. This year, it was only 29%. Levels of hiring, though, in all levels were depressed, right? The only area that saw a gain was right here, and that was in government hiring. So they were down in in-house hires. They were down up 1%, with law firms outside the top 200. Now we're going to look at hiring patterns over time for gender diverse, that's female associates of any ethnic diversity status. So this is really just women that we're looking at here. And if we look at those gray and yellow bars that represent entry-level hiring, you'll begin to see a pattern growing. In 2019, the hiring between men and women on that entry level was pretty much the same. In 2020, you begin to see women outpace the men, right? And that trend continues for the next 2 years. However, if we look at lateral hiring, men consistently outpace women on the lateral hiring, but the gap actually lessened in 2022 from 2021. So now we're looking at low ethnicity, which is sort of non-diverse women exits. So women with a low probability of being ethnically diverse return to the top 200 in fewer numbers. That's a song we're going to hear today than they did in 2021. So 26% returned to a top 200 firm in 2022 compared to 33% in 2021. And the numbers went down in every category except for government, which went up 1%. Now we're looking at men who we believe have a high probability of being ethnically diverse, and they enjoyed a higher rate of return to a top 200 firm, both in 2021 and 2022 than their female counterparts. So here they had 45% returning to a top 200 firm in 2021. That number dropped this year to 32%. They went back into another law firm under the top 200 and government by a 1% increase over the previous year. So seeing what happened with women and ethnically diverse attorneys, we wanted to check on who we believe are white males or those low gender diverse men, and to see what happened with them. And the news, I'm afraid, wasn't great. They dropped from a 37% return in 2021 to a 28% return in 2022 into the top 200. So really, the news is that far fewer are being recruited by another top 200 firm. Some folks are being laid off, some are leaving, but they're just not being replaced in the same number. So all returns are lower in the top 200 for this year. So we saw by their exit patterns where they chose to go after they left the top 200. And we wanted just to know a little bit more. So we wanted to look at female exits by age group. And looking at women in all age groups, we can see that the largest group moving back into a top 200 firm is the youngest age group, and that hits 31%. That 31% drops to just 25% in the next group, the 31 to 35 group. And it sort of remains in that general area until it drops to just 21% in the oldest age grouping. The 41 to 45 group has the largest group moving to a non-Am Law firm at 19%. The corporate world took 31% of women attorneys in the 25 to 30 age group and 29% in the 36 to 40 mid-career group. So these, now here we're still looking at women. These are laterals by JD year from 2022, and we've divided them by gender. So if you just looking from afar, you can see that there are a lot more laterals on the younger side than the older side, perfectly normal. There's a lot more associates that get, recruited than partners. And remember, here we're looking at women are in the blue color and men are in the orange color. So looking more closely, you can see that women make a really strong showing in the age groups from 2018 up, but men outpace them in the rest of the year groupings. Looking at sort of the older laterals, you can see that men outpace women by a good margin in these groups. So here we're looking at who we believe are non-diverse males and their exits from the top 200. And we're looking at the same thing. We're looking at different age groups, right? And here we see the opposite story. The largest group to exit and re-enter the top 200 is the 41 to 45 age group with 38% returning. It's a strong 33% in the 36 to 40 age group. And just note that they return to a top 200 firm more often than any other option before them. So they are being recruited and they're staying in big law more often in that mid to late career stage. We've looked at this for the last several years, and it is kind of a depressing chart, right? In 2012, it took 40% more in the number of days to make a partner as an entry-level associate versus a lateral hire. Today, if you look all the way at the end, 2022, today it's about 99% more days to make partner as an entry-level hire than a lateral. Today, laterals make partner after an average of 1,622 days. Much better than those entry-level hires, right? But look over here. Back in 2012, that number was 965. 2013, it was 911. 2014, it was a little over 1,000. So that has ballooned. However, entry-level hires face 3,299 days on average before they would be promoted to partner. Let's look here. I'm back here. That number is much smaller. 2013, it's 1,500. So it has more than doubled for those entry-level hires. It's increased about 68%. So now we're looking at promotion stats. So these are the promotion to partner stats. And as you see, in 2012, they promoted many more entry-level hires to partners than they did laterals, a big 133% more. Now you can follow this chart and you begin to see everything. It's like looking at a mirror image. Everything has flipped, right? It begins to change right here in 2017, 2018. And now in 2022, entry levels had 46% fewer promotions than lateral hires. So at first glance, it looks like entry level hires are really at an extreme disadvantage in the partner sweepstakes. But there is something else here we have to consider, and that is hiring. In 2012, this group of firms hired a good deal more entry-level hires than laterals. Over time, that pattern began to change. And in 2022, you see laterals outpacing entry-level hires by a really good margin. Only 55 firms in this firm group hire more entry-level associates than lateral associates. So the hiring pattern has completely flipped from what it was in 2012 and 2013 and 2014. Lateral hires topped entry-level hires in 2018, and it has remained the same since. So this begins to explain the time to promotion and the lack of promotion for entry-level hires, right? Their numbers just aren't the same. They are outpaced by the number of laterals. Lateral recruitment also brings in already successful attorneys, generally with transferable business to the firm or with considerable experience in the areas that the firm needs. They should become high fee earners much more quickly and therefore earn partnership more quickly. Entry-level hires are measured by the same rules, but could often just not be as successful or lack the skills to build a book of business. Firms have made a decision to hire more laterals over entry-level talent. And you can see that lateral hires really began to top entry-level hires in that 2018, and it just continued. And the widest gap was in 2022, when the market was really lateral crazy. So looking at the numbers, we're looking at partner promotion by gender for the top 200. And it's great to see the actual number of promotions go up in 2022. But let's look at the percentages. So women went up 1% in partnership number. However, the gap remains wide. Remember, there is parity on the associate level, 50-50, right? This is the level that really needs some adjustment. So we thought we would just take a look at the state of partnership by JD year, which is really the closest measurement of age that we have available to us. And if we look at everyone who is either at retirement age, almost retirement age, nearing retirement age, that percentage is at about 36%. Over a third of the working partners at these firms are slow walking toward an exit. So let's look at it this way. The mid-career bucket is about at 30%. And it may be that that group should be a bit higher considering the age of the top partnership pyramid. Mid-level partners are generally the big billers, sort of the rock of a firm's financial outlook, and that could really make a dent in profitability. We see women leaving the law in mid-career, but others are as well. Working to keep attorneys from mid-career on is really important for long-term success. We also hear that firms were bringing on younger partners in the last couple of years because the well had kind of run dry for those in mid-level partnership. And that can also affect a firm's bottom line. Jobs, jobs, jobs. The job market has really been a wild ride over the last 2 years. I mean, 2020, saw a drop of just epic proportions, and 2021 saw a hiring frenzy that looked like it would never end until it did. So this is a chart of just the jobs that were opened during 2022 by different practice areas. And you can see that litigation was far and away the largest area of need. Corporate really came in a distant second, and intellectual property followed in third place. So I thought we should sort of compare the job openings to the job closings during the same period. And we sort of got like a month by month view here. And April was the first month of the year where we closed more jobs than we opened. And that trend continued for the rest of 2022. So looking at sort of the four big practice areas month by month by month, you can see that corporate had a peak of 313 new openings in February, and then it just continued that downward trend and ended in December with only 115 new openings coming on the board. New litigation openings hit a peak in August, and they've since dropped, but it really remains the largest practice by far. So looking at the firms we cover, we can see, we looked at how many jobs were in the database in January of last year, and then how many were in there in December at the end of the year. And boy, some big number changes, right? So down 49% in the corporate practice area, down in litigation, but just 6%, which is good news. Intellectual property was down 27%. Real estate was down 40% from when the year began to when the year ended. ERISA down 40%. Insurance down 46%. And in a harbinger of maybe bad news, bankruptcy was actually up 21%. And they were seeking those attorneys, at the end of last year. Corporate specialties. So we looked at M&A down 47%, securities down 49%, finance down 51%, private equity down 41%. Litigation specialties up for insurance went up to 8%, arbitration down 10%, e-discovery down 39%, regulatory down 38%. Intellectual property, patent down 23%, patent prosecution down 21%, electrical engineering down 19%, and trademark down 53%. We also wanted to look, because we also have some international openings in our job database, and those numbers are a little different. So here in corporate, it was down 39%. Litigation was down 15%. Remember, it was just down 6% in the US. And intellectual property was down 34%. So now let's look at the new office opening sweepstakes, see who opened and closed offices in the year. And here we're going to look at all firms. So we're going to start with, the states and cities within the top 200 grouping. So the states with the largest openings in the top 200 firms, California, by far the big winner with 18 new offices. North Carolina saw 12 new offices, and Texas saw 9. Looking at individual cities, Washington, D.C. was the big city winner with 8 new offices, and Chicago, Los Angeles, Salt Lake City, and Miami all saw 4 new offices open. So now let's look at firms that are not in the top 200. And California saw the most opened offices, right? So similar to what we saw in the top 200, except here we opened 66 new law firm offices. Florida came in a distant second with 36 new offices, followed by Texas with 34 and New York with 31. If we look at those individual cities, New York City saw 15 new offices, Houston, Texas saw 13, and both Chicago and DC saw 10 new offices open. So now let's look at our net gain and losses. So in Houston, Chicago, and DC, we saw a good number of, this isn't net, sorry, these are just similar activity for the top 200 and under top 200. So they all opened offices here: Houston, Miami, Denver, Chicago, a lot more under top 200 opened offices there. DC, 8 in the top 200, 10 under the top 200. New York City, 2 opened in the top 200 and 15 and under the top 200. Where there were some differences, the top 200 opened up offices in Salt Lake City, Greensboro, North Carolina, and Minneapolis, where firms outside their grouping did not open an office. As for firms outside the top 200, they opened 9 offices in San Diego, but the top 200 did not follow suit. Now we are at the net gains and losses for offices opening and closing. And California was the big winner in the top 200 group, right? They're up 8 offices. Along with DC, Texas, and North Carolina, they had some positive numbers to show. But under the top 200, California lost 12 offices. And you may say, wow, they opened up 66 offices, and they did, but they also closed 78. So that really California had a net loss of 12 offices. And Texas gained the most, but at a net of 14 new offices, followed closely by Florida with 13 net new offices. So just a few of the data points I put up on this slide. We learned a lot from the data this year, but there's always more to know. Watching the firms both inside and out, we do see issues that we think should be watched for 2023. Associate salaries grew tremendously during the 2021 hiring frenzy, and they have significantly added to the increased cost of each hire. We're afraid that firms, while moving to plug a financial hole, may start big swaths of layoffs. And it might seem prudent now, but it may not later when they see a cool reception from candidates when the tide turns. We all saw that deep cuts during the last recession really hurt the firms in the end. Strategy is key for 2023. Firms need to find a sustained competitive advantage by not following the herd, but blazing their own path. Firms must adapt to reality. As we see, reality has changed, and they need to look for new opportunities and practices they may have previously paid scant attention to. Knowing the market and where it's headed is key. Deploying their resources in the right place at the right time could really provide an important turnaround. So keeping that strategic focus, using data to make better decisions over the next few months really could provide great opportunity. Mid-sized firms are competitors to the top 200. They are price competitive, and many are adopting alternative fee arrangements that clients appreciate. When buyers are cost conscious, all these things matter. They also have great talent and can provide high quality service with a lower price tag. So mid-sized firms were squeezed by the top 200, recruiting out of their ranks in 2021 and 2022. Some of that talent may return now that they've been sidelined. So the top 200 firms should really be careful raising rates to fill that shortfall this year, as consumers are watching and weighing alternatives. According to Thomson Reuters' 2023 market report, mid-sized firms achieved growth in their non-transactional practices in 2022, while the law firms only saw deterioration. The partner track is nearing a broken model. The old bargain is no longer working for many of today's associates. The ultimate goal has just been put further and further out of reach, as we've seen. Many of today's young associates question why they would want to be partner in the first place. In our survey of women attorneys in 2021, that was really a frequent statement. For firms that haven't already, they should begin to offer alternatives to the traditional partner track, which still enables careers to grow and flourish. Lack of growth potential was one of the big reasons that women left law firms, according to our survey. Nothing stays the same. Firms need to begin navigating a course for those who have no interest in being partner, but they still would like to have a fulfilling career. Churn is very costly. We showed that in 2021, 63% of white male attorneys left a top 200 firm not to return. That number was even higher in 2022, but due to a hiring slowdown. When you consider the many costs of each and every hire, the fees, the onboarding, the training, the assimilation, the human costs, Firms can lose millions each year on bad hiring. That chart that I'm showing there is from our BI suite. Those are conservative cost estimates. Just bear that in mind. Knowing their numbers and being strategic in hiring and not reactionary just to immediate concerns really can pay huge dividends. If firms don't know their attrition costs, they're really doing themselves an injustice. If the NLaw 200 continues to grow in lateral hiring over the expense of entry-level hiring, where does that leave today's graduates? The cost of law school has risen over 27% in the last decade. The average total cost for 3 years of law school is over $193,000, and it's even much, much more at prestigious law schools. Big Law is not hiring law students in great numbers as they did in years past, and it could set up quite the conundrum for prospective law students. And that's our look on 2022 and outlook for 2023 at the very start.
All right, Laura, thank you. A lot of good information, a lot of good stuff to chat about. That's for sure. So I want to turn it over to the esteemed panelists here to get their perspectives. Carmen, you want to kick it off, and then we'll go around the room.
Yes, Phil. So looking at this data and all of the results presented from 21 and 22 and years before, this data speaks volumes. It is actually painting the picture of what many who are on the front lines are experiencing. It is showing that all of the lateral hiring we have been doing over the last couple of years has come to a peak. And there is no right direction that will be uniform for all firms. It is showing that firms will need to be strategic every step of the way over the next 12 months. There is a lot of need in the space of integration, as is shown from the exits and the entrance points into the market over the last couple of years. There is definitely a strong need for support of diverse professionals, and it is intentional support for diverse professionals if we want to actually move the needle for those who are ethnically and gender diverse as we go forward. So those are some initial thoughts on the data.
Awesome. All right. Thanks, Carmen. Toby, your thoughts?
I was remiss in not thanking you all for including me in this. This is actually quite interesting, and I'm happy to be a part of it. I want to sort of emphasize what Carmen talked about. The diversity information is very interesting and something I think firms should pay a lot of attention to. From my prior role, my current role, the demands for diverse talent by clients is only going in one direction. And my view is we've probably already passed the supply-demand cross point, and that the demand for diverse lawyers by clients is actually greater than the supply that exists. So I think that's a very important point to be looking at. Secondly, I would say the data point that really stood out to me, and Laura made a point of emphasizing it, was that if you smooth out 2020 and 2021, the sky is not falling. Everybody's running around right now. The sky's falling, you know, existential threat, all that kind of stuff. And looking at this, it's apparent that it isn't. And especially if you consider the so-called downturn that we're in, it's been in place for at least 6 months, probably more like 8 or 9. So this is the majority of 2022 when we're looking at that data. So I'm typically more bullish, but that affirmed that for me.
Awesome. Yeah, no, I agree. And I think the big thing that we were talking about is that we're calling this more of a reset than anything else. Just kind of a return back to almost maybe even pre-2020 growth patterns with hiring that we were seeing. Ken, any initial thoughts?
Well, I agree completely, Phil, with what you're commenting with Toby's comment. The sky's not falling. I think some context helps. I think that law firm performance and growth is returning kind of back to earth from an extraordinary peak, driven more than anything else by the most M&A volume globally ever recorded in 21. And all those deals, you know, required lawyers to do them. And so there was this huge unprecedented demand for lawyers from a relatively fixed supply, therefore driving the price of those people up and creating a lot more hiring of them. So I agree with that completely. You know, it's a little bit like when you hear people talk, when you turn on CNBC, talking about crazy interest rates and it's going to be more hikes and blah, 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 blah. But if you kind of pull back and look at the historical context, rates actually aren't too bad relative to the last 50 years. They're pretty good. It's just that they were really, really low, you know, in recent years. And so it seems like they're getting higher and that's slowing the economy down. But I agree with both of you. Things are not so bad and the future is really bright. Already in Europe, private equity and M&A deal volume has started to pick up some. Softening valuations have helped that along. I think we're going to see more of that as the year goes on here. I would say the issue that's kind of slowing the demand is uncertainty more than high rates or a bad economy. It's just not completely clear what's going to happen and when. And of course, you know, that slows down investors to some extent, but there's a mountain of dry powder, you know, to be invested, and that's going to drive great work for law firms. So I'm cautiously optimistic. There's just some unknowns on the timing. You know, a couple other quick points I'd make on context. And this is kind of pulling back and giving some historical perspective. Generally in our work, we see among a group of firms that are competing to attract the same lawyers, the larger and more profitable firms tend to have an advantage among a group that are competing for the same people. And so that, and you know, not always, of course, but just generally, if group of firms compete the same people, big, more profitable, have an advantage. So that's leading a lot of firms to want to get bigger, more profitable relative to the firms with which they're competing for talent and clients and matters. And they do that in a variety of ways, right? They extend their existing strengths to try to develop a position of market leadership in areas where they're quite strong. They particularly, if they're thinking clearly, they focus on areas where they can command their rates or get better than their rates, therefore allowing them to grow and get more profitable. Simultaneously, they grow the less expensive base of leverage so that they have more profit margin in doing the work. Hence the reason why in the data, and Laura, I thought the data, by the way, was fabulous, really helpful. And I agree with Carmen. It was just really, you know, and Toby mentioned too, really, really well done. You saw that spike in the associate hiring. A lot of that is, hey, we need to push work down to people who are less expensive so we can get more profitable as we grow. And then I guess the last, you know, piece of context before shutting up is, I think if you look at it from the candidate's perspective, the lawyer's perspective, the people who have a lot of options on where to practice are really high performing people. They usually want at least two things, just basic. They want to be compensated fairly. It doesn't always mean the most they can get anywhere, but they want to be treated fairly relative to what they can command on the market. That's kind of easy. But then two, and not always as clear, they, all things equal, prefer to be on a winning team for what they do, because that creates a more satisfying experience, more interesting clients and matters to work on, more people like them, passionate about their area of practice they're passionate about. It's just more, it's kind of like if you're coming out of, you know, getting drafted out of college to play professional sports, you want to like go to a team that might go all the way because that's just a better experience. It's kind of like that, you know? Mm-hmm. And so I think that's leading firms to get bigger, more profitable, you know, to have a talent advantage if they can, but also to develop market leadership in some areas. And that's where the strategic planning work comes in that we do. They're making it, the kind of key to effective planning is making some choices about in what areas you're going to be a market leader, and then prioritizing time and money accordingly to grow. So we see, firms that are thinking clearly and strategically, that's the way we see them thinking. So I'll pause there.
Kind of piggybacking on some of that, Ken, when with respect to the things that you guys do over there, merger and acquisition activity is certainly picked up within a lot of the firms. We've already heard a couple of rumors and some actual mergers that are taking place this year. We see the office opening numbers and a lot of that, like the North Carolina, there's been some mergers, combinations down there. Any insights around that? And also what I'd be curious is, what are the types of questions some of the firm leaders are looking for when they're talking to you about what they're looking to, like, why would they want to grow? Where are they looking to grow? Is it practice specific? Is it, I'm asking a lot of different questions, but I'll let you talk.
No. It's really helpful. First of all, our practice advising on M&A is busier than it's been in 20 years by about 4 times, or maybe a little more than that. It's extremely busy with, it feels like everybody wants to talk to everybody. I mean, it's very active. Only a fraction of those deals will go the distance, though. Why are they looking? What are they looking for? The 2 biggest reasons why firms are interested in having that option on the table, at least to explore, is number 1, they usually like their firm a lot and they're proud of it, but they want to be bigger, more profitable, and more of a market leader in some areas. And so the way they usually get there, they start with lateral recruiting, individual laterals, and then they say, well, we're not making as much progress with individuals, let's look at groups. Then they look at groups. But what they realize, especially when we look at their data over a period of time, what we realize is, despite considerable time and money hiring laterals and groups, if they're lucky, people retire, other people leave. Some of the people who leave, they're happy to have leave, some they don't want to have leave. But in the end, over a 5 or 10 year period, just about every time we look at the data, no matter how great the firm is, the net growth in the areas that they're trying to grow market leadership in, it's underwhelming to them. And in many firms, it's kind of flat, even though they're hiring a lot. And so then they say, then the question is, well, do they need to get more focused in their growth and not try to hire across every practice in every office and more focused? Or do they need to also put other options on the table on how to grow, like combinations, if the combination can really move the needle in the areas they're trying to grow? And so we see a lot of firms putting the combination option on the table for that reason. The second reason is most firms feel more and more exposed to poaching, especially as some of their peers get bigger and more profitable and more money to spend taking their people. And they watch what happens to other firms when big groups get poached. And they think, God, that would be really painful. And especially for smaller firms, it wouldn't take more than the wrong few people for a lot of smaller firms to get poached before that really changes the firm. And so they feel like they can mitigate the risk of the poaching as the poaching risk increases by growing their scale and profitability so that it's not as painful if people get, if you've got a private equity group that you're really proud of and there's 10 really good people in it, it'd be painful if 5 got picked off. But if there's 20 in it, 5 get picked off, it's not quite as painful. That's so I think that's the other reason. And so they're usually looking, if they're thinking clearly in these deals, to have some criteria about what the other firm would need to look like to be considered by them. Criteria in terms of their substantive strengths, usually wanting to develop more market leadership. Criteria in terms of their financial performance. They usually want firms that help them get more profitable, that get their rates. Firms that have a culture that is compatible. That usually takes getting to know them, especially the smaller firms that don't report their data. So those are some of the things they're looking for, but they're usually trying to accomplish what they're already trying to accomplish with laterals, but just more of it and more quickly through a deal. And that's what they should be thinking. We've got a plan, which deals accelerate the achievement of our plan. That's the way we encourage them to think. And are there any? Maybe there aren't any. But rather than kind of going in a new direction, we try to think of things that would help them get to where they're already trying to go.
Awesome. All right. Carmen, is this kind of align with when you guys are talking, discussing strategy? You can get into you don't have to get into the weeds too much of your plans, but what are some of the things that you guys, discuss when you're looking to, either grow specific practices or offices and so on and so forth?
Yeah, I think, to Ken's point, exactly, the firm is definitely looking at where we can be more competitive, where we have greater rates of having success, not only in the short term, but also in the long term. No firm wants to be a one-hit wonder, open today and close 5 years from now. We take a very serious and close look at the horizon, looking 3, 5, 10 years out. What is, the firm going to look like in 2030? I think, picking up on a few of the points that Ken made, in addition to those points, it's also really important as we start out in 23 to look at where firms are growing. What are they doing not only in primary, but also secondary markets? When, Laura showed the data in 2012, as we were coming out of the former recession, firms needed lateral talent desperately, needed it quickly. And so in many cases, that meant bringing the lateral talent to where that need was, moving the lateral talent into primary markets. Today, we've now been through a pandemic that lasted several years, and we found new ways to work, being effective and efficient, whether we're working at a coffee shop at home or sitting in the office. And so now firms are looking at secondary markets where the talent is, where the talent has said, I am here, I am sitting, I am staying. I love looking out at my backyard, or I love being able to go for a midday walk. And so firms now have to figure out how to get that talent to be part of the firm for the long haul. And in some cases, in many cases, it looks like looking at secondary markets. So I would encourage looks at how firms are handling their needs going forward, not only in primary, but also secondary markets.
Awesome.
I assume you're going to
jump in.
I want to affirm generally what Kent was saying about how firms are looking at this. I'm going to add another filter because it's my favorite one. It's profitability, and I see a growing angst in the market. And I would say that what Kent was describing was the fear of eat or be eaten, and I think it's actually a valid fear because having come from a big firm and looking at the market, if you're a mid-sized firm or if you're in the AmLaw 200, in my mind, you're a target. But I know the firm, the partners of those firms, like, no, we need to maintain our legacy and all this other stuff. I'm filtering my language. But when I look at it, one thing I see firms lacking both internally and externally is profit analysis. That firms might say, oh, this is our strength, we're great litigators or whatever we are. But I can say with some certainty, there's very few, if any, firms that can say, here is where our profit comes from. And so what I would add to that angst is they're all like, how do I make a decision without that information? Like, for instance, how do I decide this is the boutique or this is the combination we should make when I don't even know what my internal profit drivers really are? To give an example applied to what Laura was talking about, because I've been doing some profitability analysis and looking at sort of next gen sort of profit methodologies. I've got a by timekeeper, by category of timekeeper profit analysis. And I'm pretty sure, based on everything I'm hearing in the market, everyone's like, oh my gosh, we have too many associates and they're not productive enough. So firms are looking at that, but this is their view. They should be stepping back and looking from a broader angle. But just, I'll give you a couple of easy stats. The first one is, well, first I'll say, I actually, the lateral versus homegrown was a very interesting thing, and you've got the old story that the homegrown people pay off their student loans and they leave. Apparently they just go to another firm that they think might be a better fit. But like 5th and 6th year, that's when the biggest margins are on timekeepers. And what we're saying is that the firm has made this big investment, and as soon as somebody has very thick margins, they leave. So the firms try to lateral in associates at that level to try to backfill that hole. So here's a stat for you. At typical 7th year, firms right now are going, oh my goodness, their hours are down to 1,600 hours. We probably need to walk them out the door. At 1,600 hours, an associate, I'll say 7th year-ish, is probably still generating $400,000 to maybe $500,000 in profit. That's after their indirect overhead costs have been paid for and after their direct compensation costs have been paid for. You'll get down to maybe 1,100 or 1,200 hours before they go negative. So if you're cutting loose a 7th year saying, hey, Sue or Bob or whomever, you're only billing 1,600 hours, we need to let you go, you're giving away a very expensive investment that is actually generating profit, and in 9 to 12 months, maybe back to 1,900 or 2,000 hours generating $700,000, $800,000, $900,000 in profit, and you just threw it to the curb. So part of my counsel to the law firms out there is you really should get to this data and make decisions from an informed place versus just this reactionary, oh my goodness. The other dimension I'll add 2 dimensions to that. One, when associate hours go soft, the first place I would look is I'll call it the service partner ranks to find out what's going on with their hours, because associate hours are probably soft because partners are hoarding the hours because there's so much incentive to do that. But that's also bad because those partners are not going to get their full rate. If you're a 12th year partner doing 7th year level work, you're probably not getting your rate. And the cost of that hour is way more than the cost of a 7th year hour. So what I'm trying to layer in is some of the economics and the profit generation here. So you think about that as you make these sorts of decisions. The other stat I want to layer in is if law firms are saying, oh my gosh, sky's falling, we need to cut underproductive associates loose. I can say from 2 different firms I've looked at that, and I would bet this is an industry-wide stat, that if you look at associate productivity by diversity, you're going to find out that the white guys have plenty of hours and the women of color do not. And so if you're going to start cutting loose based on one stat, which is hours, you are going to hurt your diversity. And I can just tell you straight up, as I said earlier, clients are demanding it. And there's probably not enough based on the demand right now versus the supply that exists. So my counsel is step back, take a broader look at this, obviously layer in the profitability, but be more business oriented as you make these decisions.
That's a good point, Toby. And we've talked a lot about diversity in the slides. The overall numbers seem to be going up, right, over the past couple of years. Now, you bring up the point that you made about laying off. We've heard numbers of firms that are laying off. What do we think the expectation is looking ahead into 2023? Will those numbers continue to rise? Will firms make strategic decisions like that with hiring? Toby, you want to just kind of take it from there and your thoughts on it, specifically with respect to diversity, and then go around the room.
Well, I think I'm going to frame it around, I'll continue sort of on the economics. My economics is one of my favorite subjects by education and avocation, and I'm one of the few people you'll meet who enjoys reading The Economist. And this is my unconfirmed opinion, but I think it's a good one, is that we were entering in another era of, quoting Alan Greenspan, irrational exuberance. All the SPACs and all that stuff that was going on, I was like, there's free money, everybody invest. And so the activity was overly frothy in the M&A market. And we know that went south. When did that go south? It went south when Putin attacked the Ukraine. And this is where a lot of that uncertainty comes from. So I'm going on record for crediting Putin for cutting off the irrational exuberance and blunting the recession we might be headed into. But part of my point here is that you know, there's a lot, and again, I track a lot of this, and there, you know, 61% of economists surveyed by the Wall Street Journal think that a recession is coming. Well, let's just be honest. We're in a downturn. Can we technically call it a recession? Who cares? We're in a downturn. Two thoughts for you. One, the downturn is not evenly distributed. If you represent tech clients, you know, West Coast firms like that, yeah, they're taking a hit right now. If you are in Texas, where I am, and you represent oil and gas companies, guess what? You're doing just fine. A friend of mine is at a large Texas only firm, and their staff got $2,000 bonuses, extra bonuses at the end of the year. So it's not evenly distributed. The other thing I would say is the demand for legal services is only going up. If you look at the regulatory environment right now, it's just getting more complicated and harder for clients to comply. Litigation, this is my anecdata for the day. My much better half is on jury duty today. She texted me and she said there are 700 jurors at the court today. And she basically said the floodgates, they told them the floodgates have opened up and the courts are open again for jury trials and all this kind of stuff. So I'm bullish on what's coming. So back to your question about diversity, I would be hanging on to every diverse lawyer I possibly could. And I would say I would be doing everything possible to retain, because Laura pointed out the churn, and you know, from my Perkins viewpoint, I witnessed that. I'm like, we should be doing everything we can to retain. Recruiting, yes, but I would have a heavy focus on retention, because like I say, I think the demand for legal services is going up. Yeah, you know, M&A is going to return. I like Kent's comment. There's a lot of dry powder. Yeah, there is. And we're already seeing movement even in the US around certain industries for M&A. So I'll stop there.
Awesome. Carmen, what do you expect the year to foretold when it comes to diversity hiring in general?
As Toby stated, you know, law firms should definitely be hanging on to their diverse attorneys. It's critical to do that now. It's more critical, I should say, to do that now. It takes a lot to get diverse talent into the pipeline when you are recruiting that talent. And so you want to protect your investment in every way going forward. You know, it's also really important to make sure that the community is one of inclusion. So as the firm focuses on diverse professionals and retaining them, it's also equally important to make sure that the environment is very much one of inclusion, and that attorneys who are not diverse know how to be supportive. They know how to be allies during this period of time, and they see the value in it. When you have a firm that understands the value of diversity and inclusion, then you can go very far. And again, when you have these periods where it may be a recession, who knows? There's a lot of uncertainty, as Toby said. But when you act not only for today, but for the future, you are better off in creating systems that will really deliver higher levels of profitability for the firm.
Awesome. And Kent, just generalized thoughts when you're talking to senior leaders of firms, and they're, you know, is diversity one of the things that they're focused on, you know, when they're looking at other firms, or what, or just in general with respect to the growth that they're focused on for the upcoming year?
Yeah, I mean, I hope the best days are ahead for diversity and inclusion in law firms, and some are making strides. I agree with Carmen's comments and Toby's comments, and I would add that law firms that we see making real progress on diversity have a mind shift from that's who we want to be, that's who we are, that's the culture we want to have, from that to actually it's a competitive advantage and we get better results for our clients when we have more diverse teams. And it's that mind shift and realizing the benefit of that I think gets some firms over the hump and make more progress. You know, I would also say that some firms that we advise have really benefited from more proactively identifying diverse candidates that they want to pursue, not people coming to them looking to move, but instead talking to their high-performing diverse and other partners and developing a pipeline of people that they proactively are going to work relationships with, sometimes for years, to try to get them. Sometimes even talking to their clients about diverse lawyers their clients are using from other firms who might be better off on their platform. And so it's some firms are reaching all the way down into undergrad and even high school, investing in programs to increase the pipeline of diverse candidates who end up going to law school and who they might have an opportunity to get. So this is an area of focus for a lot of law firms, especially ones that realize they get better results. And then I think beyond diversity, there have been some firms you've seen in the paper for layoffs. To me, those are the exception more than the rule right now. The rule is more a lot of firms saying, we've got cover to do more cleanup of people who chronically underperform our expectations, and we should pick up the pace on that. And ones that can walk and chew gum at the same time are also simultaneously aggressively recruiting in high-performing teams who help them grow their size, their profitability, their market leadership in areas they're focused on. You'll see, I expect it to come out soon, that some of the firms, even some of the ones that have been in the paper for making layoffs, are also aggressively growing at the exact same time. And it's really upgrading is what they're doing.
Awesome. All right. Well, we are a little over. I didn't want to, but I wanted to give everyone a chance to kind of give a last comment. Laura, do you have something you want to add?
Well, speaking of diversity on all levels, the numbers that we showed are the numbers overall, right, for the top 200. So you're looking at an overall number. But when you start looking at it on a firm by firm by firm basis, there are huge differences within the top 200. And for that matter, for the rest of the firms, you have firms that have maybe 5%, right? So there are firms that have really low diversity numbers. And then there are firms that have great diversity numbers. And it really just comes down to a choice, discovering that being more diverse makes them more profitable. That's a fantastic discovery. If only more people, could figure that out. But just remembering that while we're cheering that 1% that went up, it's not evenly distributed. And there are firms that could be doing so much better. And that's what we're hoping for.
Awesome. Toby, any parting words?
Yeah, there's an old capitalist maxim that says buy low and sell high, so my counsel to the firms out there is now is the time when you can buy low. When everybody else is panicking and pulling, slamming on the brakes, start looking around. There are opportunities out there. And I would, especially based on my background, be highlighting the lateral partner market. It's just there's probably a lot of unsatisfied lateral partners right now, and you don't have to give them super big numbers with 3-year guarantees to get them right now. So I would share that old maxim and suggest you maybe look at it.
Nice. Carmen, any parting words?
Yes, Phil, I have a few. First, I'd like to say I agree 100% with Toby and completely identify with buy low and sell high, given my finance background. I'm there 100%. I would also offer the following, advice to our community, our industry. Again, focus on integration. It's imperative to protect the early investments that the firm has made in hiring on the front end, and create or recreate integration programs to maximize lateral velocity. It's no longer important just to get there with speed, but to actually get there with velocity, with laterals. Firms want laterals to achieve and succeed. And velocity is key when you're talking to candidates. Secondarily, I would like to point out strategic hiring will be prioritized. Toby and Ken both said this, and you will see firms really focus with good intention on their investments this year, where firms would just hire en masse and possibly run the risk of oversubscribing. You won't see that this year. You'll see a lot more calculation and evaluation around the risk of lateral hires. All the profitability points Toby mentioned, look out for them. They're definitely coming. And depending on what is on the horizon, the intensity of it, the duration of a looming recession, a pause in the timeline of the economy, whatever you want to call it, there's a very good chance that you will see both qualitative and quantitative questions on the LPQ, the Lateral Partner Questionnaire, be redesigned to help firms be more strategic in their lateral evaluation process. And it's really important to pay attention to those things on the go forward. That no one knows what will happen ahead. There's a lot of uncertainty, but the best thing that we all can do is watch quarter over quarter and look at where we are getting velocity in the market and drive forward on that.
Awesome. And Ken?
Two things I would part with. One is, and both of these are on combinations. One is there's a pattern that we see play out again and again and again that sometimes firms, when they're thinking about themselves, don't recognize. And the pattern is that firms first say, gosh, we like who we are, but we want to be a little better and stronger. And so we're going to work on profitability. They do that. Then they say we really need to grow too. And so then they grow with laterals. And when they can't make enough progress, they try to get groups. And when they can't make enough progress, they might look at acquisitions. And it's usually not till much later that they think about deals that would really move the needle transformatively. The pattern, though, is that most firms say we're not interested in a large deal. There's some exceptions, but most say, no, we like who we are. It'll totally screw up our culture. We're good. We're doing really well. We don't need to look at that. Okay. And then if you look at the firms that do those deals, what usually happens is they've been saying that for decades, and then they start getting poached. And some of their best people who they want to be the future of their firm, sometimes in the highest rate practices, get picked off by larger, more profitable firms, is what often happens. And then on the ropes, in a position of weakness, they say, well, maybe we look at a larger deal. So they don't get picked apart, basically. That happens constantly. So our advice, I wrote a book about law firm mergers that came out last year. There's a whole chapter on don't miss the window. Our advice is don't miss the window to consider the possibility of a transformative deal from a position of strength. If you're ever going to do it when you don't need to do it, when you're strong, because you have better options, more leverage, you can walk away. It's like go to the car dealership. Don't wait until the day you have to buy. Go when you don't really need to. You can negotiate. And so one is don't miss the window. You want to be open-minded and consider these things when you don't need to do a deal. That whether or not there's something out there is another question. And if there's no deal to be had that's really compelling, then that would inform the need to stretch more on laterals and groups and make progress that way. So that's point one. And then related point two, this is really hard for law firms to develop market leadership or to hold on to it. It's hard to do it organically. It's hard to do it with laterals, hard to do it with groups, it's hard to do it with acquisitions, it's hard to do it with transformative deals. It's all hard. And there's advantages and disadvantages to every single avenue. Our advice would be open-minded, get all the options out on the table. They all are going to have pluses and minuses. Get them all out and weigh them. That's the advice. And that would be informative to what the options are. And what you need to do is choose the best available alternative or alternatives, even though they all are going to be imperfect. So I would leave it there. And I would say some firms are, I think that's why we and others who do this work are so busy. Some firms are kind of dawning on them. They should be open-minded, and that's a good thing. Thanks. Thanks again, Laura and Phil, for having me, and for my fellow panelists for the opportunity to do this together.
No problem.
Oh,
Thank you.
thank
And
you.
I
And we've
dropped-
had a couple of requests
Yeah.
for the title of your book. So give
Yes.
yourself a plug there, Ken.
Oh, that's very
I
kind.
dropped it in the chat, so I don't know if that's the right one or not, but just
Thank
confirm
you.
that.
Yeah, it's Law Firm Mergers Lessons from Successful Strategic Combinations, published by Globe Law and Business last year. If people are interested and can't find it, feel free to drop me a note.
Awesome.
That's great.
Well, we thank everyone for taking the time today to join us and listen in on this great group and the great data that we had. We will be Leopard Solutions customers will be able to get access to the video, and we're doing a white paper and analyzing the results of the survey, and then the slides, and just reach out to us if you have interest in any questions on that. But thanks again, everyone, for joining us. Thanks, Toby. Thanks, Carmen. Thanks, Kent. Oh, Laura.
Thank you all. I was just going to say, and don't forget, we're going to continue the conversation, and everyone can look for the after party of this session, where we're going to discuss a little more freely, what happened last year and what we're looking for ahead.
All right, guys. Thanks very much. I appreciate it. Appreciate it very much.
Thank you. Thanks for having us. Take care.
Thank you.
Thank you.